Welcome back to Switzer. It's now time to check with Rudi Filapek-Vandyck on the stocks he likes or really likes and the ones he thinks stink for 2014. Mate, how are you?
Peter, it's always a pleasure to be here.
Same here. Great to see you as well. Do you want to start on the stocks you don't like first? Just finish on a positive note.
Oh, okay. No. I'm going to make it a little bit different. Sorry,
okay.
I have something in my eye.
Okay.
I do bring good news, in fact.
Okay, great.
I sometimes look at stocks from a different perspective, and one of the things I do.
You look at life from a different perspective, Rudi. That's why you're on this show.
Okay. One of the things I keep a close eye on is dividend support.
Dividend support. Define that for people who don't know what you're talking about.
It means that as long as investors can trust that the dividends are there, a stock will not. It's very unlikely to sustainably fall below a certain level. Because
like the CBA's history of delivering dividends is how well it's supported.
But the CBA is a logical dividend stock.
Yeah.
I look at stocks that are less logical from a dividend perspective.
Yeah, of course.
And one of the stocks I've kept an eye on for a very long time is BHP Billiton.
Pardon?
BHP Billiton.
Yes, Billiton. Okay.
People never is a big word, but usually don't associate resources companies with dividends.
Now we did when BHP got to $30. We made the point it was paying over 4%, wasn't it? Yeah.
And BHP, believe it or not, some foreigners consider BHP as one of the most solid dividend payers in Australian share market.
Yeah, because the Americans are happy with 2 or 3% dividend, aren't they?
It's also that BHP, people forget this, but while the bank were cutting their dividends in the depth of the GFC, BHP kept increasing its dividends. So it is a very solid dividend payer. What that means, given its size and given the fact that those dividends are rock solid, is that around 4%, currency adjusted, it tends to find support. Now, here's my observation. Last year, around the...
support that significant buyers come in, and so its share price is supported because of its reliable dividend history.
Yes.
Right.
At that point, people go, 4%, I'll take it. And that's exactly what fund managers do. And that's why the share price might occasionally dip a little bit, but it doesn't stay there for very long.
Because they'd buy more. They'd probably dollar cost average if it drops to 30.
Exactly.
Yeah, right.
So if people ask me, why did they find support at 31 last year, and now at 35, well, that's the currency. It's still 4%. The currency changed, and the currency has now shifted the 4% from 31 to 35-ish. Right? So what I noticed recently is that a lot of people are afraid about how deep is this correction going to fall. And some people are talking about 5,000, 4,900. I've even seen predictions of lower, 4,006, 4,003.
Get those names, because I want to embarrass them when it doesn't happen.
Okay. But the old chartists, it's all in the charts. Okay. But see, here's my point when I look at the market from a fundamental perspective. If a company like BHP is at dividend support, that's a big weighting in the index. And BHP in itself represents probably also in its slipstream the likes of Fortescue and Rio and a few other ones.
Atlas.
And then, but Atlas doesn't really represent much in the index. But and then what I also observe is that the banking shares, which definitely represent a lot in the index, they are for the first time in 2 years, finally now trading below consensus price targets. So one of the things we do there, we amalgamate all the targets from stockbrokers.
So it makes banks a buy in the Rudi Filapek-Vandyck world.
It makes banks the best value in 2 years on a relative basis.
Well, Charlie Atkins did the same thing in the Switzer Super Report.
Anyway, combine the two, which almost means better value. You can also add to the fact that banks like ANZ now, before the surge today, were approaching 6% dividend yield.
Yeah.
That seems to be pretty good for support, I think. BHP dividend support, ANZ dividend support, the other banks. You combine those two groups, and to be honest, Peter, unless we really get something that's
a shocking jobs number and they sell off.
No, it has to be worse than that. It has to be China tumbling or something, because it has to be something that either
are you talking about a substantial structural fear in global financial markets?
Because the dividends of ANZ is pretty secure, of BHP is pretty secure, so those shares are unlikely to fall much deeper. So
You are talking rock solid tonight, mate. This is not the flaky, flunky Rudi Filapek-Vandyck. This is the rock solid Rudi.
So in essence, I guess what I'm trying to say, all the charters are waiting for 4,900. I say very unlikely, because fundamentally it doesn't add up.
Yeah.
And those are very heavy constituents of the index.
And also, looking at the run of economic data today, the doomsday merchants are going to miss out in terms of this Aussie economy. It is actually starting to look a lot better than, say, 12 months ago. Come on, Rudi.
Yes,
I'm the economist.
yes,
you're the stock market
yes,
guy. Come on, I know what I'm talking about.
Okay, here's my worry, which I had in 2013 and 2013.
Okay.
The PEs were so high that you can almost say, on a mathematical basis, the returns have to be minimal, for the simple fact that the P's are so high. Yeah. Now what we're now seeing, and that's why I'm 100% certain, a lot of fund managers have been pulling back in December and in January.
Because a lot of them were saying on this show, can't see any value.
Exactly. Yeah. And they're obviously now seeing those PEs coming back, and obviously it's not that we're coming back a lot, but it's enough. 5%. It's enough because, like I just used the example at one stage, Woodside, was also dividend support, by the way, was trading close to $40. BHP was getting to the $40. Now BHP is 35 something, Woodside is 36, I believe. ANZ is below 30, was 34 last year. Also PE-wise, it makes a hell of a lot of difference, because if ANZ goes back to 34 from 29, that's a big gain.
Yeah,
I mean,
on a quality horse.
Yes.
Yeah.
So, but where I want to temper people a little bit is that the PEs on average are still, they're not that high, but they're still relatively high. So what that sort of means is that mathematically, and obviously I'm exclude the fact that the market can become overextended at some point, always possible, but let's assume it stays within normal ranges. We should expect moderate returns. Yeah. That's main, because we already priced in so much. Yeah. That's why we had a fantastic last year.
And so, Rudi, I asked the same question of Shane. Yeah. What we need to see is earnings surprise on the high side, which will actually push those PEs down and give us a reason to buy again.
And a lot of investors always forget this. The best remedy for high PE is earnings growth.
Yeah. Yeah.
It makes it,
and that's why I love seeing a better economic outlook. Like, for example, that number in the NAB business survey today, where firms said future expectations was a huge 24. Yeah. That was, if that ends up being a true representation of what happens, that would be great for earnings.
The one survey that got my attention was Dun & Bradstreet on Monday or Tuesday.
Yeah, missed that, Colin.
And the expectations were the best in
so it's consistent
for like a million years.
And also yesterday's performance services index, new orders were 53 or 54, so they're in positive territory. Exactly. So we're starting to see a lot of good stuff, and I hope that underpins earnings.
What I have to put a little bit of caution in again, I said last